Hello and welcome. My name is John Ryan, President of CISA Trust Company, a trust company incorporated in Geneva, Switzerland in 1972. We are here to host a three-part series on U.S. tax issues. The first in the three-part series will deal with the use of foreign grantor trusts. The second will deal with pre-immigration planning to the U.S. by non-resident aliens. And the third will deal with U.S. situs assets held by non-resident aliens of the United States and the dangers that they pose to these individuals. To explain how foreign grantor trusts work, we have invited Jay Rubinstein, a leading tax attorney with Withers in Geneva. Welcome, Jay. Good to see you.
Good to see you, John. Thank you.
Jay, can you tell us a bit about yourself and your professional background?
I'm with the firm of Withers, LLP. I came to Switzerland in 2009 from the same firm. Used to work in New Haven, Connecticut, and New York on international tax matters.
Well, thank you for that, Jay. Could you please explain what is a foreign grantor trust?
Okay. Well, a foreign grantor trust, as the name implies, it's a trust, and it's got a foreign grantor, or a foreign settlor. A foreign settlor is an individual who's not what we call a U.S. person for U.S. income tax purposes. You know, if someone's a U.S. person, then they're going to be taxable on their worldwide income. So the objective here, the benefit of the grantor trust, is that you have the owner of the trust be someone who's not taxable on their worldwide income, at least during their lifetime. So a U.S. person would be a U.S. citizen, or a U.S. green card holder, or a person who spends enough days in a taxable year under a formula to be considered a U.S. person for U.S. income tax purposes. The settlor of these foreign grantor trusts, we would want not to be a U.S. person.
Thank you, Jay. Now, I understand that there are two types of foreign grantor trusts. Can you explain what these two types are and how they differ?
Yeah, so when we say grantor trust, it means a trust that is not a taxable entity, at least during the grantor, the settlor's lifetime. For a trust to qualify as a grantor trust when it has a non-U.S. settlor, it must have one of two qualities. It either must be revocable by the settlor, or the trust must provide that the only beneficiaries during the lifetime of the settlor can be the settlor and or his wife.
Now that we've understood what foreign grantor trusts are, can you please explain who might use a foreign grantor trust?
Yeah, I suppose the main situation where grantor trust could be helpful is when you have a family that has, let's say, a wealthy matriarch or patriarch or family member who's not a U.S. person, who would want to benefit either during their lifetime or at their passing, a group that would include at least one U.S. person, or might include a U.S. person.
It is said that the revocable type of foreign grantor trust is a very flexible instrument. Could you explain why this is so?
In the first instance, the trust itself can be very flexible. If we go with the revocable type, during the entire existence of the trust while the grantor is alive, he can take it back. So there is that level of security for the settlor. The settlor can give the trustee a letter of wishes as well, which would give the trustee non-binding guidance over how distributions should be made, both during the settlor's life and after the settlor's death. but during the settler's lifetime, he can obviously talk to the trustee, can take back trust assets and gift them directly, or ask the trustee to make distributions to beneficiaries.
Thank you, Jay. So I understand that the flexibility of foreign grantor trusts comes from the fact that they are revocable, typically amendable by the settlor, who has broad powers normally to determine the administration of these trusts. Now, moving over to the tax treatment of foreign grantor trusts, could you please explain how foreign grantor trusts are treated for tax purposes in the U.S.?
Right. While the trust is qualifying as a foreign grantor trust, there is no tax consequence of a distribution from the trust to a U.S. person. There is a reporting consequence, though. It's not a tax, but the U.S. person who receives a distribution from a foreign trust, including a foreign grantor trust, has to report that distribution on a Form 3520, naming the trust and describing the distribution.
So, thank you, Jay. What is the typical language that you will find in properly drafted foreign grantor trust deeds?
Well, the key language is this trust is hereby revocable by the settlor. That's number one for a revocable grantor trust. If it's an irrevocable grantor trust, somewhere in the trust it will say it's irrevocable, and it must also say that the only, however it's drafted, the crux of the drafting must be that there's no possible way for anyone other than the grantor or their spouse to receive a distribution from the trust. With a revocable trust, there's also a feature we call a step up in income tax basis of the assets of the trust at the settlor's death, so that a subsequent sale of the asset after the settlor's death will start with an income tax basis of the date of death rather than the historical, presumably lower cost basis of when the asset was originally acquired. And for a revocable trust, in order to have the step up, the trust must also provide for annual payments of either payments of income, or that the settlor of the trust can direct the income annually, including directing it to be included, accumulated as principal.
Thank you, Jay. That was very clear. Now, a foreign grantor trust has certain tax treatments during the lifetime of the foreign grantor. Could you explain what happens to a foreign grantor on the death of the foreign grantor?
Yeah, once the settlor passes, the trust stops being a grantor trust. It becomes a non-grantor trust, or a complex trust, as the technical term is. Instead of the trust being effectively transparent for tax purposes, it becomes an animal with tax consequences. And those
U.S. tax consequences.
U.S. tax consequences, yes. And the income earned year to year by the trust is not necessarily subject to U.S. income tax. It is if there's U.S. source investments, but the real tax teeth come in when there is a distribution of income, whether it's income earned in the year or income earned in a post-Grantor trust year, when it's distributed to a U.S. person.
Two very relevant concepts after the death of the foreign grantor are undistributed net income and distributable net income. Could you please explain how these two concepts work?
What we're looking at is a distribution to a U.S. beneficiary in a particular year.
Right.
We're usually measuring it just after the year ends, so we look at the distribution that went to the U.S. beneficiary that year. Then we look at what the income of the trust was for U.S. income tax purposes for that year. We call that distributable net income in that year. We also have to look at income that had been accumulated in prior years and not paid, and that still exists in the current year.
That's you and I.
That's you and I.
Undistributed.
Exactly. To the extent the distribution is the first tranche of a year's distribution is going to come from DNI, the current income. So we look at the amount of the distribution, and to the extent it does not exceed DNI for the year, that DNI comes out to the U.S. beneficiary. And as I said, they're taxed as if they earned the income. If the distribution exceeds the amount of the current year DNI, then the next tranche of the distribution is up to the extent of UNI, previously accumulated. Yeah. And that's taxed at the more onerous rate, the highest 40% approximate rate plus the interest charge. If a distribution is beyond the current year income, the UNI, and the prior year accumulated income, the UNI, then that amount is considered tax-free distribution of capital. But of course, the challenge is that if a trust is accumulating income to distribute to a U.S. person in a later year, you've got to get through the UNI, potentially at high tax and interest rates, before you can get to the tax-free capital. If the distribution is of income earned in the current year to a U.S. person, that U.S. person is taxed on it as if he or she earned the income themselves. But if the trust accumulates income after the grantor's passing and distributes income that was accumulated in one year in a later year, then distributes it to a U.S. beneficiary, the U.S. beneficiary is taxed on that income no matter what at the highest U.S. income tax rate, plus there's an interest charge which takes into account the number of years that the income was being earned in the trust, and proposes that you should have been taxed on that income while the income was being earned by the trust, and since the U.S. beneficiary didn't pay it then, they have to pay an interest charge as if that tax is payable by them.
And does that go back to the beginning of the trust, or that is from date of death of the...
From the date of death, not because all times before the date of death it was a grantor trust and disregarded.
Can you explain how you handle the accumulation of prior year's income in the most tax efficient way?
Yeah, I mean, there are a few ways that you can manage the income of a former foreign grantor trust after the settlor dies. In the case you illustrate with the wife who's going to get the income every year, that fact may solve the accumulated income problem for the kids.
So it's pushed out to the wife every year.
Yeah, if all of the U.S. measured taxable income of the trust after the settlor's death is actually being paid out to the wife, then there is no income accumulating in the trust. And if some years later the wife passes away and it's time to make distributions to the U.S. beneficiaries, there won't have been any post-settlor death accumulated income because it all went out to the wife.
Whether UNI or DNI?
Yeah, after the spouse's death, we look at, year after the spouse's death, there's income in the trust. That's DNI in that year, and it can be distributed to the U.S. kids at their natural tax rates without an interest charge. Or other things can be done to manage the income. One might decide to migrate the trust to the U.S. or distribute part of the trust to a U.S. trust. If we know that the trust in the future is only going to benefit U.S. persons, then perhaps it's time that it can be held by a U.S. trust. The U.S. trust pays the tax, but there's no onerous rate or interest charge. And the trust can accumulate income without a penalty. Or distribute the income out to someone every year so that there's never any accumulated income.
If you adopt the strategy of distributing current year income every year to mitigate the negative tax consequences of income accumulations, how much time do you have following the end of the year to distribute this income.
Yeah, so income distributions count as current year income if it's distributed in the year earned. So if it's earned in year X and distributed before December 31st of year X, then certainly it's a current distribution of DNI. And because of the practical fact you just raised, there is a rule which allows a trustee to make a distribution within 65 days of the next year and make that distribution before the end of that 65 days and elect to treat it as the prior year's distribution of DNI for that prior year.
In the case of foreign trusts, it is common practice for the trust to hold its portfolio investments through underlying companies. Could you please explain why this is so?
Right. Well, as we mentioned before, the trust may have a holding company, and in order to protect against estate tax on U.S. assets held by the trust,
like shares of U.S. companies.
Like a share of a U.S. company, if U.S. company shares are held by a grantor trust, when the settlor passes away, he will be subject to U.S. estate tax on those U.S. shares at a rate of 40%. So one technique to what we call block the estate tax on U.S. situs assets would be for the trust to hold any U.S. situs assets in a foreign holding company, like you suggest, maybe a BVI company can hold U.S. stocks, and then when the settlor passes away, what he is deemed to own is a non-U.S. situs asset, and the BVI stock, which would not be subject to U.S. estate tax. The planning issue for once the settlor passes is that, yes, he's had the BVI company which protects him from the estate tax, but as soon as the trust ceases to be a foreign grantor trust and becomes a foreign non-grantor trust, the holding company shares become a controlled foreign corporation with tax implications to the U.S. beneficiaries of the trust. If U.S. persons, including U.S. beneficiaries of a discretionary trust, hold at least, or are deemed to hold at least 50% of a foreign corporation, then they can be considered U.S. shareholders of a controlled foreign corporation, which will mean passive income earned by that foreign corporation will flow through directly to the U.S. beneficiaries of the trust, if they're deemed to hold more than 50% of the trust or the holding company. And the problem there becomes going forward with the trust after the settlor's passing. Income earned by the holding company can flow through to these U.S. shareholders, including income that would be deemed to be earned if the holding company were to cease existence, or to check the box to be disregarded as if it ceases to exist. That transaction of liquidating the company or checking the box on the company has the effect of the company selling all of its holdings for its fair market value and comparing that to its historical cost basis. And that would not be the cost basis as of the settler's date of death, but the historical cost of the stock purchased by the holding company of the trust.
And Jay, how about a two-company solution where you hold the U.S. shares in one company and the foreign shares in another company? What does this do to the planning?
You would not want to taint non-U.S. company shares in the company that's going to have the CFC issues after the passing. So one could certainly have a company with non-U.S. shares that checks the box effective either immediately before the settler's death or even immediately upon formation of the company to have it disregarded.
For U.S. tax purposes?
For U.S. tax purposes, yeah. You would not need the estate tax blocking technique for the non-U.S. stocks.
Thank you, Jay. That was very clear. Can you please explain the check the box rules?
You can make the election retroactive up to 75 days. So physically, one could make the election and have it. You don't know when the settler is going to die until he dies. So after the death, one could make a retroactive check-the-box election effective before the death. But if there are U.S. situs assets in the company, you would not want to make the election retroactive, the reverse check-the-box election retroactive to before the death, because then you will have lost the estate tax blocker at the time you need it, the settler's death. So the election for U.S. asset company would have to be after the death.
Thank you, Jay. Now, as a final question, could you please explain the difference between controlled foreign corporations, also known as CFCs, and personal financial investment companies, also known as PFICs?
Yeah, so they can overlap, a CFC and a PFIC. A CFC, controlled foreign corporation, is any foreign corporation where you have U.S. persons who own at least 10% of the company owning at least 50% of the company. And once a company qualifies as a CFC, then relevantly, passive income earned by the company flows through to the U.S. shareholders, those who are deemed to own at least 10% of the company. A PFIC is a foreign company that's passive, earning passive income, like a holding company investing in bankable assets, regardless of the percentage owned by one or more U.S. persons. So a classic PFIC would be a non-U.S. mutual fund, which is widely held. If it's held by a U.S. person, it would be a foreign passive company with a U.S. person owning an interest. That would be a PFIC. And PFICs are taxed either when the U.S. person disposes of the PFIC shares or when he receives a distribution from the PFIC. Now, we don't talk about PFICs with respect to the holding companies, because if you have a CFC, which has large U.S. ownership, the CFC rules trump the PFIC rules. So if you have a U.S. shareholder deemed to own a CFC, the U.S. shareholder won't be taxed on that company under the PFIC rules.
Thank you very much, Jay. That was very illuminating and well described. This brings to a conclusion our first in the 3-part series dealing with grantor trusts. Thank you very much, ladies and gentlemen, and we will see you for the next installment.